Welcome back to the Dividend Diplomats YouTube channel. We got your boys here. We're going to talk to you today about two stocks, my portfolio. And guess what? We are not talking about banks. This is a non-bank video. We've talked a lot about them. We're focusing on two other stocks that have come down in price and maybe time to continue building my position in these two great dividend stocks.
Two stocks that Bert owns, looking to add here in two different industries, guys. Again, non-banking, maybe some tech, maybe some semiconductors. But before we look and dive in, smash that subscribe button. Give us a nice thumbs up, guys. The community is on fire right now. We appreciate the love and support here on the channel. Almost 17,000 subscribers. Again, we have a goal. We have a goal to get to 20,000 subscribers, guys. And I know there's so many out there that are watching our videos that haven't subbed yet. So, guys, do us a favor. And, guys, if we get to 400 likes on today's video, we're going to give out some DD swag. And this time we'll let you pick the item that you want. Coffee mug, hoodie, sweatshirt, underwear. You tell us.
Yeah, there's going to be a little bit, you guys will be watching this video. It's going to be released Sunday, May 7th. So after, you get out of the Berkshire meeting, you're in your hotel room, you can wake up, watch Diplomats while drinking that hotel coffee. So everyone, get us to 400 likes on this so we can give something out. So what's happening?
Right.
We're in the heart of earnings week. That's really the crux of all of this. The Fed stole the show. Banks have also stolen the show, but buried underneath that are all the companies that have been announcing earnings. And it's honestly been a mixed bag. Over the last few weeks, there isn't like one pattern. Every company isn't crushing it. Every company isn't tanking it. Some are great, some are bad. It's a very mixed result, and that's been what's fascinating. The two stocks we're going to cover today came back down here after their earnings releases.
Hey, guys. And Bert, these are two stocks that you already own. Even better. Again,
Yep.
We're midway through 2023. The Fed just raised rates. Hopefully, maybe the last time here until they plateau. Obviously, as Bert throws his shrug up there, time will tell there.
Yep.
Market overall was pretty much flat for the week. But Bert's found his two stocks that he's been adding to. And he's wondering now, is it time to keep buying these stocks? Are these two stocks to buy right now and keep gobbling up? Because here in Cleveland, dogs got to eat, and Bert's looking hungry right now.
All right. Okay. So number one, let's jump right in. Qualcomm, ticker symbol QCOM. Man, I don't know why I struggled to say that ticker. I should know this by now. I should freaking know that Qualcomm is QCOM. So what happened? They came back down to earth after earnings. They started the year around 108, 105. They jumped up to the 130. Now they're coming back down. And earnings weren't terrible. They still performed well, but there was some weakness in the cell phone sector. I think that's really what drove it. Obviously, Qualcomm's a huge maker of chips for cell phones. The demand, they're saying, isn't going to come back. And they're also
Don't tell Apple that.
Yeah, don't tell Apple, but also Qualcomm has to still figure out how to diversify away from Apple. So that two negative news caused some negative sentiment for the stock. It was down 5 to 6% after earnings. Next quarter, they're expected to still earn between 170 to 190, and they're going to have revenue somewhere between 8.1 billion and 8.9 billion compared to management. So still solid numbers, but softening demand, and that's what you saw with a lot of the other chip makers too.
Yeah, I think what overall revenue is down about 17% when comparing to Q2 for them, year over year. So not looking great on the revenue front, like you said.
But still, what we're going to do is we're going to run Qualcomm and the next company through our stock screener. We're going to run through three simple metrics. 1, PE ratio less than the S&P 500. 2, payout ratio less than 60%. 3, history of increase in dividends. And 4, that dividend yield. And the beauty of this is, despite the negative news, you're going to see why Qualcomm has hopefully popped up on my watch list. Hopefully you'll see the numbers and be like, yeah, that makes sense that they're a stock to watch based on our Diplomats dividend stock screener.
Yeah. Again, Qualcomm crushing it. Good balance sheet for the most part. Really nice current ratio, quick ratio.
Yeah.
Well over 1x. So I do like their liquidity position during this tough time.
Yeah, it's great. So let's jump into the screener. Metric 1, their price is 108.78 after this earnings. Forward EPS is 9.97. That PE ratio is 10.91, so less than half of the S&P 500 today.
Yeah, I love that. And the dividend payout ratio is looking pretty sweet here myself too. They pay a nice 80 cents per share per quarter, or $3.20 per year for QCOM shareholders. guys, like this video if you haven't already. Like this video if you're a Qualcomm shareholder. Payout ratio, though, based on the 997 expected earnings right now is 32%. So if you guys want a safe dividend with a definitely easy potential to keep this next metric, the average dividend growth rate up, Qualcomm is looking pretty right.
Yeah, they haven't had the largest increases. Their 5-year growth rate's 5.64%. They've increased for 19. Their last increase was right in line with that 5-year average too. And yeah, again, they've increased that dividend for 19 years. So they're on the doors of becoming an aristocrat. They're almost 25 years here. So you gotta love that. And Lanny,
Yeah.
what is that yield now that the price has come back down to 108?
Yeah, and why the growth rate works okay here in this situation is because the dividend yield's approaching 3%. So we're almost at a 9% dividend factor. They're yielding 2.94%, which is almost 2x what the S&P 500 currently yields. So yeah, you definitely get a nice little, kickback from a dividend from Qualcomm.
Yeah. So to summarize, PE 10.91, payout 32%, nearly 6% dividend growth rate, 19 years of increasing dividends, and a yield of nearly 3%. They are up 1.47 today. And just to give a quick summary here on my position, we own 33.372 shares. Our market value is at 3,600, and it's down. Our overall cost basis, we're a little lost. Cost base is $4,029. So, but we're down about what, 400-ish dollars or so. So it's not the end of the world, but a good time for us to continue lowering down our position. An annual dividend from them is 106.79. I love the fact that we're nearly dripping one share at the current prices.
Wow, really nice. But
Yeah.
Bert, let's dive into that dividend stock. Number two, and you've been asking the community quite a bit here, talking about real estate investment trust. Which one is their favorite, the best one, which one they've been buying recently? Obviously, real estate's in its own little different 2023 right now, especially with high interest rate debt happening. But what's the second dividend stock here?
American Tower, ticker symbol AMT. I've talked about it for a month and a half, and you're right. High interest rates are not great for REITs, especially not great for REITs that aren't particularly great at managing their balance sheet. REITs, by the nature, with large real estate transactions, have a lot of debt. So debt service, interest expense are major components of a REIT's balance sheet and income statement. So the higher the interest rate, higher the interest expense, less free cash flow, less potential money to pay out for dividends. So that's really the big kicker for REITs. But what I like about AMT is it's a little bit more conservative on the REIT front. It's not going to be the highest yielding REIT. Definitely not. It's never going to win an award for the highest dividend yield, but you also feel a lot better about the dividend that's going to come from this REIT. So currently their yield is 3.17%, well below some of the other REITs out there that most are what, between 6-8%. A lot of people are buying REITs that are 10 to 12%, but
12 to 15%.
yep, I'm looking for a nice, safe, conservative REIT. And Lanny, you want to tell us a little bit about AMT?
Yeah, I mean, obviously they're in the cell tower space, guys, and the battles right now between T-Mobile versus Verizon versus AT&T versus everybody else. They're also saying you're either with us or you're against us. That's what AMT is saying to Crown Castle. But guys, again, they need to, not to no pun intended, but they have to band with these mobile providers here. Obviously they have massive quarters of building new sites. I think 11 consecutive quarters of building 1,000+ new sites is what they headlined.
Yeah.
So, again, they're trying to really grow that network capacity to keep taking on more, especially as 5G takes off. Who knows when 6G is already in the pipeline, but again, they're trying to be the premier provider for network connectivity.
And that was the interesting thing management was saying. They're putting up so many sites, and it's not that this is going in vain. This is, from what they're seeing, the beginning of an investment cycle. So how fast 5G and how fast 6G are going to get rolled out. The big carriers are going to have to continue investing, and they believe they're at the front of it, and they're well positioned to continue dominating it with the addition of all these cell towers. That's what's great for them. It's interesting, though, their earnings were also phenomenal. Revenue increased 4% to $2.7 billion. The property revenue, too, jumped up as well. That made up the majority of their revenue. So it was great to see that the property revenue hung tight with them. Their FFO guidance is now jumping up to it nearly $10 per share. It's $9.53 to $9.76 range, which was increased from $9.49 to $9.72. So they're increasing their FFO guidance. Things are getting a little bit better for them. Q1 crushed it from the FFO standpoint too, 2.54 per share versus 2.46. So a lot of great news for AMT. It's kind of just a slow, steady, consistent grower, which is what I kind of want for my portfolio, especially with all the dividend cuts, the Paramounts, and everything else, Intel that's been going on in my portfolio this year.
Yeah, I mean, I think with AMT, when you look at them from the DD stock screener, instead of earnings per share, we'll focus on funds from operations, FFO, because of the REIT status.
Mhm.
Yeah, trading at almost $200, $196.75, down though this year over 8%. When you look at that $9 and change for funds from operations standpoint, PE's, or price to FFO is below 20 right now at 19.99. So, not cheap,
Mhm.
not like super expensive where they're in the 20s, but kind of at reasonable value right now.
So let's look at the payout ratio when using FFO, $6.24 dividend. That gives you a payout ratio of 63.41%, which in the sector is very low. They have plenty. I would consider them a very safe dividend from the REIT standpoint. Most REITs, you'll see the payout ratios in the 70s, 80s, 90s, even 100% for a lot of these 15% yielders right now. So when I say I'm looking for a conservative REIT, this is why it checks that box. The dividend payout ratio just isn't that high for the sector. It's very, very manageable.
Yeah. I mean, when you look at dividend growth, again, very consistent 5-year growth rate, 17% for over 10 years. Do rock a 3.17% dividend yield, so definitely on the lower side, as Bert was indicating. But guys, this is quality. You pay for quality.
Yeah.
You either get the local pizza with the local ingredients or you buy Papa John's. Chances are the local pizza is a little bit more expensive than Papa John's. No disrespect. But you pay
No,
a
it
little
sounds
bit
like
more
you're
for
sounds an
quality.
awful lot like you're disrespecting Papa, ticker symbol Papa, in this video here, Lanny.
What else I was going to mention too, as Bert mentioned, experiencing the Intel cuts, the recent freaking Paramount cut, Para. Let us know in the comments if you also endured some of these cuts recently. Obviously, what's going on in the banking industry, buying some quality assets such as AMT, Bert, is a really good move. How much do you own of AMT right now?
We own 3.526 shares, so only $693.74 with $22 of annual dividend. But I said earlier when we started buying it, I want to get to a goal by the end of the year of at least 10 shares of AMT. The price jumped up, so I stopped buying it, and it's coming back down. So this is a good chance to just every once in a while grab a share of AMT. I can grab half share. I don't have to. Beauty of this is in 2023 investing, you don't have to grab full shares when you're buying. You can grab $100 half share for AMT. That is the beauty of it. Don't tell
Yeah.
Lane with his daily purchase strategy.
No. I mean, I think it's bingo. I mean, you hit it on the head. You don't have to wallop in $200. You can do heck, where you can do $10 a day into AMT and just use that as your AMC price ticket right there.
That's right. So to summarize here, price per FFO 19.99, payout ratio 63%, 5-year dividend growth rate 17%. They've increased for 10 years with the yield of 3.17%. So obviously, I like both these stocks. I'm gonna have no problem adding to them at these price levels over the next few weeks. It's a pretty easy conclusion for me. I would have no problem buying either.
Guys, let us know in the comments. Do you like Qualcomm over AMT or AMT over Qualcomm stock? Do you own both of them? Let us know. Again, we're trying to get to 400 likes. So if you're here on this video, take a second, wait a minute, like the video. We want to give out some gear, some dividend. Again, the sweatshirts and hoodies are awesome. Those are definitely a big favorite. Obviously, a customized mug is also a fun one. So definitely like, subscribe, and leave a comment below to enter that giveaway. Let us know what other stocks you've been buying during this banking crisis, during the high recession and dividend cut era that we are in with some of those big companies. Just let us know in the feedback.
And just remember too, if you're not with us, you're against us.
Guys, that was Bert and Lanny, the Dividend Diplomats, over and out.